Welcome to the Money Matters Show, where I explore the money topics that matter most to high-income earners and retirees. I'm your host, Steve Balch. Join me as I share expert insights, actionable strategies, and thoughtful conversations to help you protect, grow, and optimize your wealth. Let's dive into what really matters when it comes to your financial future. Hello, and welcome to episode number 5 of the Money Matters Show, where we talk about money matters for high-income employees and retirees. Today, we're going to talk about taxes, and not just this year's taxes, and potentially as we're looking at tax filing day coming up in the next couple of weeks. We're talking about bigger picture, how to prepare for 2025 and beyond, how to lower your lifetime taxes, right? Unfortunately, there's no way to avoid taxes. It's a part of how the system works, and it's something that we're going to have to always do. However, there are things we can do to potentially reduce our tax bill over time. And so the first thing you can look at, especially if you are a high income earner, is looking to max out your 401ks, right? You can get upwards of $23,500 in for this year in 2025. And if you're over 50 years old, you can add an extra $7,500 for your catch-up, getting your total to $31,000, which would defer taxes and lower your taxable income. If you are between 60 and 63, there's a super max catch-up, which gets you a little bit more, a little over $11,000. That's something you may want to plan for, is more to be able to defer even more taxes. The idea here is if you're in a higher income bracket, you want to defer taxes now. And when you get later on, potentially maybe in a gap year or between retirement and RMDs and Social Security or an early retirement, you will be able to withdraw those funds at a lower interest rate. So if you're maybe in a 24 to a 32% tax bracket, you can defer those taxes at that level or even higher, and maybe in a 37% tax bracket. And then when you take funds out, you might be taking out the 22% tax bracket, and your effective tax rate may be even lower. So one of the first things to think about if you're looking to lower your tax rates for your lifetime, and for this year, look at maxing out 401ks and retirement plans. The second option you can think about is Roth conversions, right? Think about paying taxes now and let money grow tax-free. There are some things to think about, right? What is your tax bracket this year? What is your income going to be? And how is this going to work? If you are someone that's preparing for retirement or in retirement and you have those gap years, right? You've retired, your income is lower, you haven't started Social Security, you haven't started required minimum distributions, this is where you can potentially look to fill out and take some money out and pay those taxes now. Other things to consider, right? If you're a high income earner and you potentially are in a gap year or something has happened that your income is lower, you may want to think about taking advantage of that lower income and do a Roth conversion for the year, right? And let that money grow tax free. Also, potentially ways to do Roth conversions if you're in a high tax bracket and you're always going to be in a high tax bracket, or you're in a lower tax bracket. When market downturns happen, large corrections, large pullbacks, even bear markets, it's a great time to think about taking out some of that money, converting it from an IRA to a Roth, and let money recover into a tax-free account over the lifetime of the portfolio. Continuing that idea of Roth conversions, you might want to think about also what we call bracket filling. So for instance, if you are in the 24% tax bracket for 2025 and you're married filing jointly, your income is somewhere in the range of $250,000 to $300,000, there's some room in that 24% tax bracket all the way up to roughly about $394,600 for 2025. And so it may make sense to think and say, hey, wait a minute, the 24% tax bracket is a pretty attractive tax bracket, and the next move up gets you more towards the 32% tax bracket. So it may make sense to think about taking advantage of the tax bracket, right? If you have roughly $250,000 of income, you have about $144,000 left that you can use until you fill out the rest of that tax bracket. And so you may want to think about doing some Roth conversions, taking funds out, withdrawing from an IRA, again, making sure you're over 59 and a half. You don't want to have the 10% penalty, but it may make sense to think about paying taxes now, doing tax bracket filling, especially if you are thinking about retirement or you're in retirement, right? Especially those in retirement that have not started required distributions yet. It makes sense to do tax bracket filling to make sure that you're taking advantage of that full tax bracket. Other things you want to think about is investing with taxes in mind, right? So there's ways to defer taxes, which are contributing to retirement accounts or other contributions that you can have to deduct your funds. Then you can pay taxes and look for things to go tax-free with the Roth and everything, or Roth conversions. But then we also want to make sure that we're doing asset location. You want to make sure you have the right investment vehicles inside your right accounts, right? For instance, if you have actively traded mutual funds, or you have REITs or other types of investments that pass out capital gains or high income in taxable accounts, and you're in a high tax bracket, or you are a retiree, this may impact your taxes. You may be paying unnecessary taxes and hurting yourself, putting yourself into a higher tax bracket, losing deductions, or pushing you into IRMA surcharges, right? So you want to make sure that you have asset location and investing with smart investments. So your growth-oriented portfolio should be in your Roth. That grows tax-free for the rest of your life. Your taxable accounts should be more in indexed ETFs, low turnover, efficient investment vehicles, right? Even muni bonds. In your IRA and tax deferred accounts, this is where you can have actively traded mutual funds. You can have taxable bonds and other types of vehicles that are not as tax efficient, because anything that's passed out is not paid taxes on it. You only pay taxes on vehicles or withdrawals out of the IRA. So from that standpoint, you want to make sure that you have the right investment vehicles. Asset allocation is important, but you also want to make sure that you take those funds and put them into the right asset location so there's not unnecessary taxes for you. Another great way to lower your tax bill for this year and in the future is to think about charitable contributions. If you are charitably inclined, there are ways to take advantage of your charitable giving and make sure that you're getting the most tax benefit for that. So simple first one is, if you do give to charities, you should not be giving cash positions. You should be using appreciated stock, right? Let the appreciated stock be given to a charity, and then that charity can sell that stock and the capital gain goes away. You don't pay on the capital gains taxes, right? If you're looking for potentially a bigger deduction from a tax standpoint from either a large investment of stocks, like let's say you have a big vesting option of RSUs, or you're doing a large Roth conversion for the year, a great way to potentially lower your taxable income for the year is doing a large donation to a donor-advised fund. Right now, again, we'd want to be giving appreciated stock. So let's say I bought stock for $100,000 and that stock's appreciated $200,000. So I have $100,000 of unrealized capital gains. If I were to gift that $200,000 to the donor-advised fund, I get a $200,000 charitable deduction for this year. The capital gains are sold and put into donor-advised funds. I'm not paying taxes on the capital gains. And then I get the $200,000 deduction potentially on my taxes. Again, depending on your tax structure, and if you itemize, there's lots more nuances to that, but we're talking about the high level here. This allows you to potentially take a large deduction on your taxes and lower your taxes for this year. Now, the great thing about the donor-advised fund is you don't have to distribute those funds all in one year, right? You can take that $200,000 and slowly bleed it out to various charities over time. And so it's a great way to front load and create essentially a foundation for yourself to be able to give to charities over time while getting the tax benefit for this year. Now, another great option if you're charitably inclined and you're in required minimum distribution years, you can do what's called a qualified charitable distribution up to $105,000 for 2025, where you can gift out of your IRA directly to a charity, and that will help cover your required minimum distributions, and it's not a taxable event for you. Now, there's one thing to make sure of this. You need to make sure you're giving directly to the charity. If you take out the $100,000 or $105,000 into your own account and then give the charity, it's not going to be as tax efficient. So you want to make sure you're thinking about, if you are charitably inclined, let's say that you usually give $20,000 to charities every year and your required distribution is $50,000, right? You can give to the charities directly out of your IRA, the $20,000, and that's going to lower your taxable income for the year. And then the rest of the RMD, the $30,000 to get to the $50,000, would be a taxable distribution. But that's a great way to potentially lower your taxable income for retirement years as well. Just for a note, you cannot give money out of your IRA directly to a donor-advised fund. I know people have thought about that, but that's not allowed. So a qualified charitable distribution has to go directly to a charity, and it has to be done in the year that you use it, basically. Other options to think about for potentially reducing your taxable income for this year and into the future: using HSA accounts and 529 accounts, right? The HSA account, if you have a high deductible insurance plan, you can contribute funds to an HSA that deducts or lowers your taxes for this year. The money can grow tax-free. And when you take funds out for qualified medical expenses, you have tax-free income going back to yourself. So if you have a high deductible health insurance plan, it makes sense to potentially look into adding or contributing to a HSA for the year. 529 plans are another great option. You don't necessarily get the tax deduction. Some states do allow it. You don't get a federal tax deduction, but it does allow the money to grow tax deferred. And if used for qualified expenses for education, it is also tax-free distribution. So that's a great way to grow assets and appreciate assets and pay for one of potentially one of the largest expenses you're going to have for your children with education in a tax advantage way. The last strategy you want to think about for lowering your tax bill over your lifetime is proper estate planning, right? Estate planning is going to make sure that the assets are properly titled and go to the heirs properly, but it also can help you avoid large taxes over the lifetime of your assets, basically, right? Currently in 2025, as long as your assets are below $13.99 million, there is no estate tax that's going to be levied on your estate. If you're married, then you each get the $13.99 million, so the total exclusion is $27.98 million. But if you have above that exclusion, there's going to be a significant tax levied on assets above and beyond that $13.99 million, right? So potentially thinking about giving funds to irrevocable trust to get it out of your estate and let those assets appreciate to lower your estate bill are things to potentially think about. You also think about charitable trust or charitable giving, or also giving to the exclusion per year, right? Which is $19,000 for 2025. So you can give $19,000 to friends, family, relatives, whoever you feel like at the end of the day, without having to file the gifting tax and not using it into your lifetime exclusion. So if I'm married and I have 2 kids, I can give my son and my daughter $19,000. My wife can give my son and my daughter $19,000. So we can give a total of each $38,000 to our kids, which would not have to be filed and go against our exclusion, essentially, right? So estate planning is a great way to potentially lower your overall tax bill over the time of your estate, right? If your estate is large, there could be significant estate taxes you're going to have to pay. So proper estate planning, using charitable giving, gifting per year are ways to lower your tax bill for your overall estate as well. Look, if you're a high income earner or retiree, taxes are most likely going to be one of your largest expenses you're going to pay over your lifetime. I provided 7 ideas to help you lower your taxes for 2025 and potentially lower your lifetime income over the rest of your life. If you have questions on these strategies, feel free to reach out. I'm happy to help. And as always, if you're a high income earner or a retiree and you're looking to simplify your finances to get time back, like and follow along. The information given here is taken from sources IFP Advisors, LLC, DBA Independent Financial Partners, IFP Securities, LLC, DBA Independent Financial Partners, and its advisors are believed to be reliable, but it is not guaranteed by us as to the accuracy or completeness. This is for informational purposes only and in no event should be construed as an offer to sell or a solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situations, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purposes without IFP's express prior written consent. Investment advice offered through IFP Advisors, LLC, DBA Independent Financial Partners, a registered investment advisor. IFP and Certified Financial Planning are not affiliated.